Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Richard Lewis, Investment Director at Downing. Hello, Richard.
Hi.
First off, can you just tell me a little bit about Downing and also give an introduction to yourself?
Yeah, sure. Yeah, my name is Richard Lewis. I'm Investment Director at Downing. I've spent the last 15 or so years in the venture capital industry, working in classic funds, then investing off the balance sheet of a very large global organisation, and I joined Downing in early 2017. And Downing is a asset management company based in the UK with more than 1.1 billion of funds under management, deploying capital to support growing, ambitious UK businesses.
And can you tell me a little bit about the Downing FOUR VCT? It's a new share class, isn't it?
It is. It launched the back end of 2016, so maybe 18, 19 months ago. Two share classes. One a generalist share category, another one a healthcare focused one. And we're looking to build a interesting, high quality portfolio in both share classes. We think we've got deal flow which can build something very, very interesting.
And how much are you looking to raise this tax year?
We're going back to the market in October and looking to raise a maximum of £60 million across the two share classes. Do
you want to just give me some flavour of the types of companies you invest in?
Yeah, so from the generalist funds, we have investments in a whole range of sectors, including retail, e-commerce, software, lots of tech-enabled businesses. One very interesting one we made recently was in a business called Channel Mum, where we invested alongside both strategic investors and high-quality financial investors. It was founded by Siobhan Freegard, who previously founded NetMums very successfully, and she came back to try and build a significant business in video marketing targeting millennial mums. So we supported that business and we'll continue to support that business with more funding over the next 12 months.
And what did you like about it?
As I said, very high quality team who'd been there and done it before. We also, I mentioned there are some great shareholders already in the business, ITV as a strategic investor, and we invested a lot, another VCT. So these companies typically need more capital than you anticipate. So working with investors who can follow their money is really important to us.
And other examples of companies you've recently invested in?
In education, we backed a company called Third Space, which is the largest online tutoring business in maths. Very, very good business. This is a genuine growth capital situation, so an existing business, and our capital is going to be used to grow the business. And we think there are opportunities in other markets, both domestic and overseas.
And are there any particular companies at the moment? I know it's early days, but is anything doing particularly well?
Those ones are doing well. Channel Mum is ahead of plan. We have others which are now starting to raise capital at a valuation in excess of where we invested. But as you said, that we started pulling this portfolio together over the last year or so. So it takes a little time for these companies to mature, but there's some great signs.
And any companies not doing so well?
Yes, there are some which are performing less well than we would like at this stage. One example is we invested in a company called Destiny Pharma when it floated on the AIM market, and due to the vagaries of the AIM market, the price has declined a little bit. But we're expecting, as the results of the clinical trials they're going through start to be released in 2019, there to be a decent recovery in share price.
And there's a lot of VCTs raising at the moment. Are you finding it hard to get good deals? Are you competing against a lot of people?
For the really high quality entrepreneurs, that they will get offers from various funders, so we work very hard to generate proprietary deal flow. And then we really emphasise what we contribute in excess of the capital. So at the moment we are starting to build a network in the US, because most of the companies, particularly in the tech sector, are going to, if they're looking to raise Series C or D or beyond, probably the investors are going to come from the US. And likewise, when you're looking to exit a business, a good number of potential acquirers are going to be US based. So we're helping our companies network in that part of the world, and we're finding that can help us win deals.
clearly Downing in the past has always been known very much for energy and asset-backed deals. The new rules mean there's a big change in direction for anyone. How's that affected you?
It's been business as usual for us in that you're right, some deals are prohibited from VCT funds, but we have quite a long history in investing in the venture capital space through some of our EIS funds. But both Downing itself and also the team have got great experience of investing in slightly early stage opportunities and probably going to be all equity structures. It hasn't had a huge impact in what we're doing.
And Richard, if I want to invest in a VCT this year, why should I choose you?
I think we're well placed to build on the interesting assets we've already got in VCT 4. We've got a very good pipeline of transactions, and some of the reason for that is that we've built a ladder of funding. So any company looking to raise from 250,000 right up to 5 million and the annual limit available under the VCT scheme, we can support. So a lot of the time we'll invest in early stage companies through our EIS funds. That provides great deal flow for our VCT funds, who can then pick up when these companies at a slightly later stage and need an injection of more meaningful amounts of capital.
Richard Lewis at Downing, thank you very much.
Thank you.